video explains how to do the simulation part of the case. So as I told you the other day, you can use the simulation template that we have in Blackboard. Just take it and modify it using your own data, and let's see how we can do that. So in our case, we have only two variables which depend on the state of the economy, which is the units and the salvage value, whereas in this template we had four variables which depended on the state of the economy. So to adjust this to our particular situation, I'm going to get rid of this two here, and I will leave only the units and the salvage value. Let's denote it by S, say. Okay, so according to the case, and if you want to call this a recession, you can. If you want to call this slow growth, you can. And if you want to call this strong growth, you can. Okay, so according to the case, in the state of recession, we have 300 units. In the state of slow growth, 400 units. Strong growth, 500 units. And with salvage value, in the state of recession, we have $100,000. In the state of slow growth, $400,000. And in the state of strong growth, 900,000. Okay, and the probabilities are also provided. In the state of recession happens with 35% probability in both cases. State of slow growth happens with 40% probability, and the state of strong growth happens with 25% probability. Okay, so now we're going to randomly generate a number. Based on that, choose the quantity, and again randomly generate a number, and based on that choose the salvage value. So I don't need these two columns here anymore. I'm going to delete them. And the random numbers are already generated. You don't need to generate them again. So here we randomly generate a number between 0 to 10. And based on that number, we need to choose the quantity. So you can see that if the random number is less than 3, so we have to change that because the recession happens with probability of 35%, not 30%. So it should be 3.5 instead of 3. Then we choose the recession value. If the random number is more than 3.5, again, it should be 3.5, but less than, or should be less than 35 plus 40% should be 75%, right? So less than 7.5. Then we'll choose the slow growth value, and otherwise, if either of those previous stations is not true, then you will choose the strong growth value. So there you have it. Once you adjust those probabilities, just drag this down. Okay, so to make sure that all the iterations have the same expression. And here we're randomly generating the salvage value. Again, random numbers are already there. You don't have to generate them again. You just have to adjust the expression here. So according to this, if the random number is less than, we have to change this to 3.5 because, again, we have 35% probability. We choose the recession value. If it is more than 3.5, but less than 7.5, we choose the slow growth value, and otherwise, if previous two statements are not correct, then we'll choose the strong growth value. Okay, press enter and drag this down to make sure all iterations are using the same expression. And there you have randomly generated units and salvage value. Let's also make some adjustments here. Our initial investment is $1.11 million. For the cost of capital, you will calculate the weighted average cost of capital in part 1 of the case, and we'll use the correct number. Let me just go with 15% as we have here, but please make sure you use the correct weighted average cost of capital. Tax rate in this case is 38%, and salvage value, we don't really need this, so I'm going to delete that. Okay, so once you have that, you can go to the other side of this spreadsheet and start generating the cash flows. Now, since this is a 5-year case, we don't need 10 years of cash flows, right? So I'm going to select this part and delete this because I don't need that. I just need to generate cash flows for 5 years. Okay, so here you can adjust the annual depreciation percentages. In the first year, in this case, we have 33%, 45% in the second year, 15% in the third year, 7% in the fourth year, and of course after that, depreciation is going to be 0. Okay, so let's see, initial outlay. So initial outlay is, of course, the purchase of the equipment, as we have here. But if you remember, we also need to add to this the investment in working capital, right? There was another $30,000 investment in working capital. So let's add that as well and drag that down. So that's done. Okay. Now, cash flows. Now, how are we supposed to generate cash flows? So if you remember, in this case, we have revenues, then we have to subtract variable cost, then we have to subtract fixed cost, then we have to subtract depreciation, then we subtract taxes, we get net income, we add back depreciation, and also add the changes in net working capital. Okay, so in general, your cash flow in a given year is going to be revenue minus variable cost, right, minus fixed cost, minus depreciation. Then you multiply that by 1 minus tax rate to calculate net income. You add back depreciation, and you also add or subtract, plus or minus, the changes in working capital, net working capital. Okay, so that's the expression that you need to use to generate the cash flows. So let's see. Now, revenues. To generate revenues, I need the units, which I have randomly generated here, and I need the price. So price is $1,500 starting in year 1, and it increases by 6% every year. So maybe I can, specify what the prices are here in this row so that I can use them in generating our cash flows. Okay, so maybe I can call this price, and the price is $1,500 in the first year, and it grows by 6% in subsequent years. So multiply by 1.06, the previous value, and drag this across. So that should generate the prices for the next 5 years. So there we have the prices. So now let's see how we can generate revenue. So revenue should be units multiplied by the price, right? So we have units multiplied, please change this to price. Okay, so C13 where you have units and L11 where you have the price gives you the product, gives you the revenue. Okay, so there we have it. Now let's subtract variable cost. So variable cost is 45% of revenues. So again, should be units times the price. Okay, so units times the price times 0.45 is going to be your variable cost. So this portion here is the variable cost. Next, you subtract the fixed cost. Fixed cost is just a given number, 70,000. Okay, and then you multiply that by 1 minus tax rate, and you add back the depreciation tax shield. So let me come back to this in a moment. See, you can generate the cash flow by taking the depreciation outside of brackets here and combining it with this depreciation, as a result of which you're going to have the following expression. So revenues minus variable costs minus fixed costs times 1 minus tax rate, and you add back depreciation tax shield, which is depreciation multiplied by the tax rate. And that is the expression that I used in the original template. And let me use that here as well, because it's actually a little bit shorter than this expression. So maybe that will allow us to save some time and work here. Okay, so now again, let me go back to the expression of the cash flow. So we have revenues here, we subtract variable cost, we subtract fixed cost, as we have here, right? Then we multiply by 1 minus tax rate, as we have here, and then we have to add back depreciation tax shield, which is the tax rate multiplied by the amount of depreciation. So what are we depreciating? We're depreciating this initial outlay, $1.11 million. So if I take the initial outlay and multiply by the depreciation percentage, as we have here, 33%, so this will be my depreciation in year one. And when I multiply that amount by the tax rate, I end up with depreciation tax shield. So please note that here I have a negative sign in front of the initial outlay because that number is negative. So I'm just putting a negative number here to make sure that the depreciation that I'm calculating here is a positive number and the depreciation tax shield is a positive number. Okay, so this, what we have here, is this portion up to here. So revenues minus cost minus fixed cost times 1 minus tax rate plus depreciation tax shield. Now we have to add to this also the investment in net working capital. Okay, so how we can do that? If you remember, the investment in working capital was 11.25% of the difference between the revenues in year one minus the revenues in year two. So what is the revenue in year one? Is the units multiplied by the price in year one. What is the revenue in year two? Is the units times the price in year two. Okay, so that should be, this portion should be the investment in working capital in year one. Okay, so press enter, and there you have the cash flow in year one. And we should generate the remaining cash flows in a similar fashion. So, for example, cash flow year two, we need to take the units in that we randomly generate and multiply it now by the price in year two. Okay, so that will be your revenue in year two. Then subtract variable cost, units times the price. So let's change that, multiplied by 0.45. So that would be your variable cost in year 2. Subtract $70,000, which is the fixed cost, multiply by 1 minus tax rate, add depreciation tax shield back, where you take the initial investment, multiply by the percentage of depreciation in the second year, times the tax rate. So it's all there already. No need to change anything. And then add, again, the change in working capital, which is the 11.25% of the difference between the revenue in year 2, right? So I'm taking the units, which I have in cell 13, multiplied by the price in year 2. So that would be revenue in year 2, minus the revenue in year 3. So again, I take the units, which I have in cell C13, and I multiply by the price in year 3. And there you have the cash flow in year 2. And so on. So cash flow in year 3, units times the price in year 3, minus units times the price in year 3 times 0.45, minus fixed cost of 70,000, times 1 minus tax rate, add depreciation back, it's already there, you don't have to do anything, and then add the investment in working capital, which is C13, which is the units, multiplied by the price in year 3, so that will be revenue in year 3, minus the units times the price in year 4, that will be the revenue in year 4. There you have it. Year 4 cash flow, again, units times the price in year 4, minus units times the price in year 4, times 0.45, minus the fixed cost of 70,000, times 1 minus tax rate, add back depreciation tax shield, and add to that the investment in working capital. So units times the price in year 4 minus units times the price in year 5, which gives us the cash flow in year 4. Now, finally, in year 5, there's more action, meaning in year 5, we need to recover the investment in working capital, whatever we invested in working capital in previous years. And also in year 5, we need to add the after-tax salvage value, which we randomly generated here. Okay, but the initial part is the same. So again, units times the price in year 5, minus units times the price in year 5 times 0.45, that's the variable cost, minus $70,000, which is the fixed cost, times 1 minus tax rate, add depreciation tax shield back. And now let's see how we can recover the investment in working capital by doing the minimum amount of work. Okay, so let me come back to that cash flow in a moment. Let's see how we can actually generate the recovery of working capital. So how much did we invest in working capital? If you remember, we invested $30,000 in year 0. Then 11.25 times revenue in year 1 minus revenue in year 2, right? Plus 11.25 times revenue in year 2 minus revenue in year 3. So that will be investment in working capital in the second year, and so on. So let me do it again. So negative 30,000 plus 11.25 times revenue 1 minus revenue 2 plus 11.25 times revenue 2 minus revenue 3 plus 11.25 times the revenue 3 minus revenue 4 and plus 11.25 times revenue 4 minus revenue 5. Revenue 5, right? So this is 30,000 in year 0. This is the amount in the first year. This is the amount in the second year. This is the amount in the third year, and this is the amount in the fourth year. This is how much we invested in working capital in years 0, 1, 2, 3, and 4. And we need to recover this amount. We need to get this amount back. Okay, so by looking at this expression, I can see that, for example, for example, this revenue 2 here is going to cancel this revenue 2. Okay, this revenue 3 is going to cancel this revenue 3. This revenue 4 is going to cancel this revenue 4. Okay, so as a result of which, I'm going to be left, if I simplify this expression, right, I'm going to be left with this. This is how much we invested in working capital in previous 4 years. 30,000 times 11.25, difference between revenue in year 1 and the revenue in year 5. And that's what we need to recover in the last year, in year 5. Okay, so since this is a negative amount, essentially, and we need to recover a positive amount in year 5, you just need to put a negative sign in front of that expression to get that done. Okay, so let's remember 30,000 plus 11.25 times the difference between revenue 1 and revenue 5. So if we put a negative sign in front of it, then it's going to be 30,000 plus 11.25 times revenue 5 minus revenue 1. So that's how much we're going to recover in year 5. So now let me go back to my year 5 cash flow and do that. Let me add back the 30,000 and let me add to that 11.25 times the difference between revenue in year 5, which is the units in C13, times the price in year 5, minus the units in C13 times the price in year 1. So that this here is going to be the recovery of working capital in year 5. So we're almost there. In year 5, we also need to recover the after-tax salvage value of our equipment. Right, so again, let me come back to that in a moment. What are we recovering? We're recovering the after-tax amount of these salvage values which we randomly generated here, right? So how do we calculate after-tax salvage value? As salvage value minus the tax rate times salvage value minus book value, right? But we know that since this is a 5-year project, but we're depreciating the asset over 4 years, the book value at the end is going to be 0, okay? So in this particular case, this book value is 0. We don't have it. So that's gone. As a result of which we have salvage value minus the tax rate times the same salvage value. So if you simplify this expression, that would be simply salvage value times 1 minus tax rate. So that is the after-tax salvage value. Okay, so let's add that to the cash flow in year 5 as well. So add to that the salvage value, which you randomly generated here, times 1 minus the tax rate, which is here. Okay, so you can fix the tax rate so that we can drag this down in a moment. Okay, So there you have the cash flows generated from year 1 to year 5. So let's now drag this down and populate the remaining iterations here. See, when I drag this down, it gives me an error because I guess we have to adjust some of the values here before dragging it down. And what we need to adjust is the price. We need to fix it, the price. Okay, so tax is fixed, and these values are fixed, and we need to fix the price here as well. So now let's try. Now it gives us a value, a correct value. Just take a quick look at all the ingredients that you're using and make sure that everything is all set. So it looks good, so I'm going to drag it all the way down. The same thing here, you need to fix the price to drag this down. So let's do that by putting these dollar signs for the prices, and we can drag this down. Let's do the same thing here. Let's fix the prices. And here. And drag this down. In year 4, same, fix the prices. Drag down. And finally, in year 5, fix the prices. Here. And drag this down. So there you have the cash flows for 1,000 iterations. Here in the original file I had 1,000 iterations. You don't need to use 1,000 iterations. I'm asking you to do only 25. So feel free to get rid of all that part of the spreadsheet. So finally, in the last step of this iteration of the simulation, we need to calculate the NPVs. I had a separate column here for the after-tax salvage value, but we don't need it anymore because we have already incorporated the salvage value into the cash flow in year 5, so that's not necessary anymore. Okay, so finally, in the last step of the simulation, we need to calculate the NPV, okay, using the NPV function. So NPV, first, you specify the discount rate you're using. So as I mentioned, your discount rate should be the weighted average cost of capital, which you calculated in question 1. So please, change that number there after you know what your weighted average cost of capital is. And then you select the cash flows from years 1 to year 5, like this. And then you add the initial investment outside of bracket separately because, as you know, if you include it in the function, it will discount it as well. We don't want that. So that's why we add the initial investment outside the bracket separately. And there you have the NPV of the first iteration. So you can drag that down and you can calculate the NPVs for the remaining iterations. And here it's already all set up. Here it automatically calculates the average NPV. Here it automatically calculates the standard deviation of those NPVs. And here it automatically calculates the probability of getting a negative NPV. So using the function normDist, normal distribution, here we're making probably strong assumption that these NPVs are normally distributed, but let's go with that. So normDist, then you specify the cutoff value x, which is 0. Why 0? Because we're trying to estimate the probability of a negative NPV. So probability that the value is going to be less than 0. So 0 is the cutoff point. Then you specify the mean of your distribution, as we have here. Then you specify the standard deviation of the distribution, and the final ingredient, cumulative, should be true. So you should be using the cumulative distribution. And then it calculates the probability of realizing a negative NPV. Or alternatively, you could simply count the number of negative values here out of the total of 25. That should also give you more or less the same probability of a negative NPV. Okay, so that's pretty much it for